The RBA has just jacked the interest rates up by 0.25%.
Now, I know this is not the news that Australians with mortgages want to hear, but it is the right thing for the economy. So taking all these factors together, the board decided it was necessary to raise the cash rate.
Now, depending on where you are in life right now, this is either the worst news that you have heard, or this could quietly be the first bit of relief you've felt in months. Hey guys, Scott here. Now, the RBA has just made a move that a lot of Aussies were hoping would not happen. Mortgage holders were absolutely biting their nails, sitting on edge of their seat, hoping the RBA would not jack the rates up, but they did. Now, inflation has actually picked up again, and the RBA decided it could not sit back and wait. Now, here's what makes this decision feel strange, and most people have not clocked this yet. Australia has just moved against the rest of the world. We are an outlier here. Across the US, Europe, and other major economies, central banks are holding rates steady or cutting them. They're trying to protect growth in a world that's already full of geopolitical tension, trade risks, and fragile confidence. Australia just went the other way. So in this video, I want to talk you through 3 really important things. Firstly, what the RBA actually did. Second, what pushed them into this decision and what the big banks think will happen next. And third, what this really means for you and your repayments if you've got a mortgage. So stay with me, because right at the end, there's one part of this story that almost nobody is talking about. One group of property owners will not feel this move the same way others will, and that difference matters. Quick one before we get into it. I break down property and economic shifts like this all of the time, every single day. So if you want clarity without the noise, subscribe and hit the bell. All right, let's start at the top. So the RBA have lifted the cash rate by 0.25%, taking it from 3.6 to 3.85%. That is the first rate hike in more than 2 years. And importantly, the decision was unanimous. There was no split on the board, no last minute hesitation. They were 100% aligned. So this was not a panic move, but a deliberate and calculated call. The next question is obvious. Why raise rates now when the rest of the world is trying to do the opposite? Does the RBA not care about households struggling with the cost of living crisis? Do they not want to protect the Aussie economy against external geopolitical pressures? The short answer is inflation. The longer answer is that inflation didn't just stay high, it moved higher again. It's moving in the complete wrong direction. In the year to December, headline inflation rose to 3.8%, up from 3.4% the month before. Trimmed mean inflation also lifted to 3.3%. That matters because the RBA's target range is 2 to 3%. From the RBA's point of view, inflation is not only above target, it's proving sticky and is rising higher every month. And when inflation hangs around longer than expected, central banks get nervous. They also made another point. So let me skip all the jargon on this and break it down in plain English. The RBA believe people are still spending more than expected. Demand in the economy hasn't cooled enough yet, and the labor market is still extremely tight. Unemployment is low. Now, you might have seen headlines blaming government spending for inflation, but the RBA was pretty clear and defended the federal spending. They are putting more weight on private spending and demand, not government budgets, as the main driver right now. Whether you agree with that or not almost doesn't matter. The RBA makes the call, and this is how they're reading the economy, which brings us to the next big question. What is the RBA planning to do next? Is this the start of a long hiking cycle, or is this a one-off move? Here's where things calm down a little. Commonwealth Bank, Westpac, and ANZ are all forecasting just one rate hike in 2026. This one, the one that just happened. They are not pricing in a long series of increases. NAB is the outlier, and even NAB is only expecting one more hike later this year, not a prolonged hiking cycle. So the way to think about this is simple. The RBA has thrown the punch. What happens next depends on inflation. If inflation cools, they stop. If inflation stays stubborn, there may be one more move. Either way, based on the big banks, we are not looking at 4 or 5 hikes this year. Now let's talk about the part that actually matters the most, what this means for mortgage holders. Let's put some numbers around this, clear and simple. I'm assuming an interest rate of around 5.76% as a starting point, just to show the impact. If you've got $1 million mortgage, your repayments rise by about $160 a month. That's roughly $1,900 a year. On a $750,000 mortgage, repayments rise by about $120 a month, or $1,400 a year On a $500K mortgage, you're looking at roughly $80 a month or $960 a year. And on a $250K mortgage, it's around $40 a month or $480 a year. This hits variable rate borrowers first, and many lenders pass it on quickly. A lot of people are going to get hit with this in their next repayment. Fixed rate borrowers won't feel it today, but if you're rolling off a fixed rate soon, you're stepping into a higher variable world. And that's why this feels heavy. A lot of Aussies were already stretched, rent is high, groceries are high, energy bills are high. This is one more cost layered on top. But here's where the story starts to shift. So what does it mean for the property market in 2026? Will the rate hikes crash the property market? There are a lot of Aussies praying for that. Rate hikes change the property market in two main ways. The first is psychological. Buyers don't just buy with spreadsheets. They buy with confidence, they buy with emotions and feelings. When rates rise, uncertainty creeps in. Some buyers pause, they wait, they sit on the sidelines, telling themselves prices will finally fall. That hesitation reduces competition. This means fewer people at inspections, less heat at auctions, more room to negotiate. The second impact is on borrowing power. Higher rates mean people can borrow less, which naturally slows momentum. But property isn't driven by rates alone. Supply is still incredibly tight. Population pressures are still there. Demand for property has not disappeared. So what this move is more likely to do is slow the pace, not reverse the market. And that slowdown creates something extremely interesting. When the crowd gets nervous, the market gets quieter. And quieter markets can actually favor buyers who are ready and prepared to buy. Now, this brings me to the final piece that most people are gonna miss with this rate hike. So here is the part almost nobody explains properly. This rate hike does not hit every property owner the same way. Now, if you're an owner-occupier, you absorb this directly. Higher repayments come straight out of your after-tax income. There's no buffer, no offset, it just costs more to live. But there is one segment of property owners that does not absorb this rate hike at full force, and that group is property investors. Now, let me be very clear here, because this is where people get confused and get it wrong. Most investors do not simply jack up the rent every time rates rise. In many cases, rents are locked in through a lease, maybe 6 months, 12 months, sometimes 2 years. In other cases, investors choose not to pass the full increase on to tenants because they want stability. So in reality, investors often absorb most of the increase themselves in the short term. You have to remember that for an investor, interest repayments on the mortgage for the investment property is a tax deduction. So when interest rates go up, the interest expense goes up, and that will increase the tax deduction. So yes, it will mean a higher repayment for the property investor, but it will also mean a higher tax refund for them, meaning that they do not absorb the whole hit. In a lot of cases, most of my clients will only absorb half the hit. That's why rate hikes tend to hit owner-occupiers hardest, while investors feel a softer version of the same move, and that difference matters. So what does this absolutely present for property investors? Well, it actually creates a golden window or an opportunity to get in at a market that may in fact hesitate over the next 3, 6, and 9 months. We may not see the crazy growth that we have seen over the past 2 to 3 years in a lot of locations. We may in fact see a little bit of a slowdown, allowing us to catch our breath and to go in and to negotiate on property. And in a lot of cases, in a lot of the zones that we're targeting to invest, those properties can become more negotiable on price because there is less demand on those properties. So whilst repayments may go up, prices in many cases can go down, especially if you have got the ability to deal with wholesale property, off-market property, and you can negotiate in bulk on that property. More about that in another video. There's a key trend that people also need to look out for with this rate hike. Now, rate hikes will impact the premium end of the market a lot more than the lower end or the affordable end of the market. And in fact, I did a video about this a few days ago about a 2-street or a 2-lane market. And what that means is, as rates go up, properties with bigger mortgages become a little bit more unaffordable. And what that means is people may in fact move away from the higher end and start looking at the more affordable end. This can create more demand for affordable properties because the demand for property has not gone away. We still have population growth, we still have demand for property, meaning we still have buyers. It just means that these buyers now will more concentrate on the lower end of the market. All of these factors need to be considered before putting together a property selection plan if you're going to be investing in 2026. Ultimately, what does 1 or 2 or even 3 rate hikes mean for the property market from 2026 to 2036? Absolutely nothing. The property market will still continue to march forward based on market fundamentals. We will see an average of 6 to 8% per annum annual growth on property over the next 10 years. So that's the breakdown. The cash rate is now 3.85%, up from 3.6% after a 0.25% hike. Mortgage repayments rise, and the increase depends on your loan size. And for property, this is not automatically a crash signal, this is a slowdown signal, and hesitation creates opportunity for the right buyer. Now, I want to hear from you. Do you think this is a one and done? Or do you think NAB is right and we get one more hike later this year? Drop your view in the comments. And if you want regular updates on property and the economy, hit subscribe and hit the bell. Thanks for watching, guys. This is your daily property update. Keep watching these videos every single day so you can become a property insider. See you at the next one.